We're half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Our top stories today. The benchmark across the region here flats as concerns mount over China's economic challenges here. Major mainland benchmarks are set to open at fresh 6-month lows as risk appetite continues to slump. Now, key U.S. allies are being dragged deeper into this superpower tech tussle, with Beijing warning Japan of severe retaliation over these ongoing chip curbs. Plus, Cathay Pacific in focus this hour forced to cancel some flights for inspections of its Airbus A350 fleet. Let's try it again over issues with their Rolls-Royce engines.
It's been a pretty quiet Tuesday morning. If you take a look at how risk assets are doing here, we're flat when it comes to U.S. futures, and we're still waiting for, of course, the Wall Street to reopen after that Labor Day holiday. So there's not that much follow through from what we got overnight. Asia Pacific is still slightly steady here this morning, and you are seeing Taiwan open up pretty slowly here this morning as well. Dollar yen's at 147, so we're seeing a little bit of weakness, and that it seems like we're steadying now after weakening against the dollar over the past week or so. Treasury markets are opening up just a little bit the last few hours in Japan, and we're seeing yields tick up slightly higher here. But we're watching very closely what goes on with oil markets in particular. There's been that force majeure once again in Libya that we're focusing on as well. That did keep, see a little bit of uptick when it comes to oil prices. We're slightly lower here in the Asia session, but take a look at iron ore. We tumbled back down below $100 now. We're at 96 for futures in Singapore, and you're seeing that across some of these metal space in commodity futures in China as well. Iron ore and Dalian is down some 2%, and you are still seeing declines across the board when it comes to steel, copper, aluminum as well. We're still kind of being weighed down by those China concerns, just given what we saw from that PMI data over the weekend as well. The setup to China is like this. There was a bit of a decline yesterday. In fact, Chinese stocks had one of the biggest drops in a month. Really, and you take a look at the CSI 300, Shanghai Composite falling to 6-month lows now. Futures are pretty flat this morning, and 711.88 for the currency, Dave.
Yeah, we'll get the fix in about 13 minutes from now. And to Yvonne's point, of course, the dollar continues to be in focus amid just the lack of activity we're seeing across these equity markets. Right now, we know, of course, how soft the market has been onshore, and in particular yesterday. So on top of the drop we saw on the major benchmarks like the CSI and the Shanghai Composite, the small caps actually took a massive hit yesterday. So whether you're looking at the Star 50 in Shanghai or the Beijing 50 listed in Beijing, record lows as far as those are concerned. Cathay Pacific will be very much in focus this hour, of course, on the back of the news overnight that it is inspecting or needing to inspect, of course, some of its engines on its A350 fleet. The property story in Hong Kong is really more a day two of what happened yesterday following the warning from New World. And New World fell 12% yesterday. We're a few days from another big Hong Kong developer reporting, which is Sunghyun Park reports on Thursday. And as Yvonne is pointing out, of course, some of the softness we're seeing in things like iron ore also in focus today. Right, so where are we as we get underway this Tuesday? So we are at fresh 6-month lows on Shanghai Comp and the CSI 300. Shenzhen is still hasn't quite took out the lows just yet, but again, it's almost everywhere you look. There's just signs of softness in this market.
Yeah, and they're just, it's really been driven by the data, at least for the last few sessions. But when you take a look at earnings, it's really the earnings story that has disappointed as well.
Yeah. Especially
if you compare China with the rest of Asia, rest of the world, they're basically at the bottom of the barrel here right now when it comes to performance.
Yeah, I think when you look at, say, the Hang Seng Index, and this is the aggregate surprise. So you take the index, you take the aggregate earnings, you take the aggregate average, and the bottom. Well, the bottom part of the list here are all Chinese benchmarks, right? Which I guess our colleague Sebastian Boyd pointed out as well. It might also be because, and we hear this a lot from analysts, that the forecasts and earnings are always on the higher side of things. So do we need to adjust our lenses to account for what seems to be an almost structural over-optimism here into the earnings season?
Yeah, he particularly talked about those PE ratios, right?
Yeah.
They actually seem high. compared to what we've been seeing with the earnings.
Yeah.
So we might need to see that these Chinese stocks have to go a bit cheaper first.
Yeah, I think it's 8.1% is the figure that Sebastian put out there. So just say for example, I think if we're trading at 10 times earnings, then you have to add 8% on top of that PE to get, I guess, a more accurate gauge of, and you just to adjust for the earnings expectation. So on top of that, we're entering September as well, which is a almost ghost month when you look at how stocks have actually done historically speaking.
Yeah, let's bring in Geoffrey Lunt, head of Asia investment specialist at HSBC Asset Management. Seems like people are getting into this month a bit weary, given that seasonally it's not good for stocks, not good for bonds either. How are you approaching the next few months?
Well, I think there's two key questions, Yvonne. The first is, can the global stock rally actually continue? And the other is, where are bond yields going to go from here? So, that's the real focus, because in many ways you could say that, and as your graphic showed, that a lot of stock markets have performed well, that there have been good earnings growth, but at the same time, valuations are reflecting that as well. So, and from the bond side, as we've been discussing earlier, that spreads are quite tight. So, it's actually quite a challenging environment, I think, for asset allocators at the moment.
Lean into risk, or do I step aside for the moment? What's the view from the team?
Well, we remain confident in certain stock markets. We still like the US, we still like Japan. And from a credit point of view, we are cautious about credit spreads where they are at the moment, but you don't want to be short of duration, I think. And the all-in yields of credit products are still, I think, very attractive. And the risk is asymmetric for investors. I think that the chances of losing a lot of money investing in credit's quite low, whereas you could easily achieve mid to high single digits in quite safe credit, and perhaps even more in emerging markets in Asia.
And what assumptions are you making in terms of where bond yields go? Are you think we can continue with this Treasury rally?
Yes, I think so. Yeah. I mean, we're on the verge of I don't want to bore people with our view on Fed funds, but we seem to be on the verge of a loosening cycle. I think that we think that it could go even further than perhaps the market consensus over the medium term, and therefore there is downside potential still, I think, in Treasury yields.
Right, and the bulk of the returns or performance in fixed income has really been, I think, it depends where you look, but if you had to pick a group, it was high yield that really did very well in the last 12 months or so. Do we continue to? Would you suggest leaning further into high yields? Would you go up the quality spectrum, for example? You mentioned duration. Don't give up on duration at this point in time. Just your broad views on where exactly value is right now.
Well, there seems to be a lack of catalyst for significantly wider spreads. And when you look at corporate balance sheets across the world...
Isn't that a scary thing, that you don't see the risk?
I think we do see the risk. Okay. I think that this is somewhere to be cautious, but not to be too short, because you will potentially miss out on quite good returns. If you remember, at the beginning of this year, and indeed the beginning of last year, there was quite a lot of pessimism around high yield. Everybody said we need to be in quality because we're facing potentially a US recession. In fact, high yield, as you rightly say, was the place to be. And that phenomenon could continue. I think what we don't want to do is to, as you say, lean in too much into an environment where economies may be slowing down, where you might get slightly higher default rates over the next 12, 18 months. But to still remain confident. I mean, the environment that I've outlined of continuing rallies in stock markets is not one where you would necessarily be too cautious about credit either.
We're already seeing, I think, 200 basis points of Fed cuts priced in from now until 2025. Do you think that we can still see that much movement in bond yields, even for the dollar? Can it actually sell off further from here?
Well, in terms of bond yields, I mean, the Fed fund assumptions, I think that they could be fulfilled by the end of 2024. But at the same time, I'm not sure it really matters that much whether we get 4 or 3 cuts. I think it'll be one of those.
Sure.
But I think that the prospects of rates into 2025 are the more important phenomenon in that respect. And in answer to your question about the dollar, yeah, perhaps we could get a slightly weaker dollar, and that is something, again, which could boost emerging markets in this environment.
Are you having to push back at, again, cash strategies, even amid what seems to be almost a certain Fed cut this month? Money just keeps going into cash, and I'm wondering what you think about and what you make of that phenomenon.
Well, the only thing that I can say for sure, David, is that at some point investors are going to have to move out of cash and to protect themselves against those interest rate cuts, because obviously their rate of interest will decline at the very short end. And I think that time is probably now. It might even have been a few months ago. And so we are seeing and we are encouraging investors to move further down the yield curve, to have more duration. In the immediate short term, obviously, you lose a little bit of yield in an inverted yield curve. But we think that that will be more than compensated for the drop in yields that you're going to see over the coming quarters, where you will be better off protecting yourself in that slightly longer bonds.
It seems like now, in terms of sentiment around China, it just keeps getting worse. If the economy weakens further from here, what markets do you think will be most at risk?
I mean, I think that we think that China remains a stock picker's market. I mean, you have to go back to base to a great extent. You have to remember that China is the second largest economy in the world. It's one of the most innovative. It's one of the most original. It's one of the least correlated. And you can see the types of alpha that portfolio managers in China are achieving by picking the right stocks. This is a stock picking market, we think, still over the coming quarters. There isn't enough economic momentum at the moment. We still need to get over the real estate funding crisis. There needs to be a resetting, a recalibration of that part of the economy in order for a generalized significant improvement in economic growth. In the meantime, though, you can't, if you avoid China completely, there's a very good chance you're leaving opportunities on the table.
All right, Jeff, we're going to leave it there. Geoffrey Lunt there, Head of Asia Investment Specialist at HSBC Asset Management. Coming up next, Volkswagen weighs factory closures in Germany for the first time ever as Europe's auto industry loses ground to Chinese rivals in the EV race. Plus, how a slowdown in Chinese consumer spending is leaving Hong Kong's luxury malls like this one nearly empty. We look at the struggles of the city's wider retail sector later on in the show.
Yep, we're just counting down to the open of trade in Shanghai and Shenzhen and here in Hong Kong, and we're coming off quite a steep drop in mainland markets yesterday. Futures are pointing slightly higher. The fix is coming out in a couple of minutes too, and pay attention to flows across the stock connect, particularly southbound, on the back of a massive amount of money which came the way of Hong Kong yesterday from the mainland. The opening bell 16 minutes away. This is the China Show.
Your RMB fix just crossing the Bloomberg here this morning, and it's pretty much bang in line with what estimates were, 7-11-12 this morning. And yeah, we're pretty steady around the spot levels here as well, Dave.
Yeah, going into about 4 minutes away until we get the initial pricing on Cathay Pacific. As things stand, though, it's looking like the shares are going to open about flat. Today, the big news, of course, is the airline says it's being forced to cancel some flights for, well, precautionary inspections here of its entire Airbus A350 fleet after, well, discovering issues with some of the engines. Let's bring in our aviation reporter, Danny Lee, who broke the story for us and knows the details. Before we talk about the disruptions to flights, what do we know about the problems with the engines?
It's components which I found that have an issue. They haven't specifically said what, but after checks after an issue during one of its flights, it's given cause for concern for them to inspect the wider fleet. And if you're another airline operating the A350, you'll be a little bit concerned given the issues that the wider industry has faced over the last several months and even years, for example. So Cathay is taking a precautionary measure, as you said, just checking. And so for Cathay, it is a bit of an issue because they are a big operator of the A350 fleet. So if they're having to make fleet-wide checks, it's going to be a bit more of a bigger impact, as we see with their scheduling in the short term.
Yeah, what are we hearing about disruptions so far? Quite a lot of cancellations.
Quite a lot of cancellations over Tuesday and Wednesday. So, for example, the Singapore route that Cathay operates on, only 1 out of 9 flights survives today. So, quite a big issue for the Singapore route. But I've heard that the loads there are quite low, so they can afford to cancel on one route in a big way.
Wasn't there was a flight from, was it in Taiwan or going to Taiwan recently that had to abort the takeoff because of a fire in one of the engines? I'm not sure if you heard about it. And does it have anything to do with that news? I'm speculating.
Yeah, it doesn't. It was a different type of Airbus aircraft.
Okay.
But, at the same time, all of these things, get magnified when you have effectively 2 engine issues over a very similar time frame. But at least for what we see with Cathay, clearly other airlines will be watching closely. Regulators around the world are taking notice. And really, we need to wait and see what the outcome of these checks have shown, and particularly, is this going to be a short-term band-aid fix or something that is going to be longer-term and more systemic and more of a concern to the industry at large? Yeah,
and just quickly, how did the airline give any guidance on how long these disruptions will last, for example, beyond the next 48 hours?
For now, we are hearing that it's only going to be for the next 48 hours or so. Okay. Cathay are going to give an update later on today. They say they've got parts ready and waiting to be put onto these planes, but again, is this only something that they need to do one time, or do they have to do multiple times and make multiple checks?
Danny, thank you, Danny Lee there, our aviation reporter on the latest when it comes to Cathay. We'll be watching that stock when it opens in just a few minutes' time. Let's talk about Tesla shipments as well and stick to sort of the transport theme. From Tesla shipments from Shanghai and its factory there increased in August for a second straight month, and that's after Beijing doubled a subsidy encouraging drivers to trade in older cars for electric models. Let's get to our Asia transport reporter, Linda Liu. She's with us now. Linda, we saw basically those numbers were up in August for Tesla. Does this suggest that this sort of cash for clunkers program is actually working now?
Yeah, it seems like this trade-in subsidy scheme that the government doubled at the end of July from 10,000 yuan to up to 20,000 yuan is starting to take effect. Industry associations said that the boost from the subsidy scheme seemed to have lifted the entire EV industry, with the deliveries growing by about 30% in August. And Tesla seems to have benefited from this boost as well. Like you said, its China shipments from its Shanghai factory have increased for the second straight month. That actually is a contrast from a very slow start for Tesla in the first half of this year, where it saw shipments decline for several months compared to last year. So hopefully this boost will continue for the rest of the year for a much needed relief from a very competitive industry right now.
Linda, just to pivot to the big take today, and really one of the most read stories is really this pivot from VW, possibly that historic decision after nearly 90 years of, they're mulling closing one of some factories in Germany. What's that about?
Yeah, this is sending shockwaves throughout the industry because it marks a major turning point for Volkswagen that the good old days may not be able to continue with this onslaught of EVs changing the entire auto industry. It shows that legacy makers like Volkswagen is not doing very well in its effort to transition to EVs. And you've got the added pressure from a slumping European autos market that hasn't yet recovered to pre-pandemic levels. All of this is also impacted by economic slowdown in China, where a slump in spending from Chinese customers that make up one of the biggest markets for Volkswagen. Essentially, all of these negative factors are just forcing Volkswagen to take this drastic step of considering to close one or some of its German factories.
And just goes to show the competition with some of these Chinese rivals is just so fierce right now. What does this move from VW then mean for the legacy car-making industry's efforts to transition to EVs?
Yeah, this actually just adds to a whole series of gloom that we've seen for the electric vehicle industry. We've got a lot of other legacy automakers, including Ford. You've got brands like Cadillac as well as Mercedes-Benz. They're essentially walking back their original electrification goals, saying that this transition to EVs is going to take longer than they expected. Now, this comes as the global demand for EVs is weakening. You've got consultancies like JD Power lowering its sales forecast for big markets like the US, where the electric vehicle sales growth has been cut from an expected 12% to 9%. While China is still holding up some of that growth, that trend is also slowing. So it's not a good outlook for the entire industry.
Linda, thank you so much. Linda Liu there, our Asia transport reporter. You can read the full article on VW and today's big take that's available on the terminal for Bloomberg clients and also on Bloomberg.com. Right, so going into the Tuesday session, just under 7 minutes away, and it's been, well, we're hoping to mull other things because there's nothing happening in these markets. More on nothing just ahead. This is Bloomberg. We're looking at flows across the Stock Connect very closely today. So yesterday, amid the weakness onshore, we saw the second biggest amount bought through the Stock Connect of Hong Kong, through to Hong Kong from the mainland for the year. So that's the most since March. And I think, mainland investors, this is a theme we've seen, taking advantage of, I guess, better performing assets here in Hong Kong.
Yeah, and we continue to see that outperformance in Hong Kong. We're taking a look at when it comes to the consumption space in China. We're getting a downgrade here when it comes to the China Tourism Group. 8 shares cut to a hold at Daiwa with a price target of $45. Just after their first half earnings missed estimates. And they're talking about shopping sentiment still remains weak, according to Bloomberg Intelligence, and outbound travel dilutes traffic. You're looking at Xiaomi as well. Morgan Stanley raising the price target there, saying the company is better than expected performance in EVs and AI that could support the growth outlook. Using mining shares also reinstated outperform at Macquarie. The Open is next. This is Bloomberg. You're watching the China Show. We're countdown to the opens of markets, and it's a pretty slow going one here today. We're still waiting for the jobs report at the end of the week. The U.S. markets were closed on Monday, so there's just not much to really talk about. Volumes are slightly lower here this morning, and we're still dealing with maybe some of these wobbles in the Chinese economy that is worrying markets here right now. And we're still focusing on developers here today. What else?
Well, I mean, that's it.
That's it.
I mean, there's the jobs report, and here's something I learned yesterday, and this is not relevant to really investing. So on Saturday, it's actually World Beard Day.
Beard?
Yes.
Not beer, beard.
Beard.
Okay.
Beard. Although people who do have beards also tend to like beer. The opening bell is upon us right now with some very useless trivia for you guys as well. But yeah, I mean, jobs report pretty much is the highlight for the week. Volumes are about 45% lighter than usual across the region today for this time of the day. As you can see, declines are persisting, albeit somewhat, of course, on the mainland. We're looking at, mostly in particular, so on the first row, the third and the fourth tiles you see on your screens. That's the Star 50 and the Beijing 50 index. We're looking at declines there still. Well, a little bit of a pop today in the Star 50. Both those small cap indexes actually hit a record low yesterday on the back of, I think, 2-3% losses. Flip the boards, please, and have a look at Hong Kong and where we are here And the story, of course, is this avalanche of money coming through the Stock Connect into Hong Kong, the second most amount net across buying into Hong Kong stocks, 0.3%, and you are seeing that, I guess, as far as price goes here. Bottom of your screens, and very, very quickly, some of the movers or the lack of it. So we're looking at Cathay Pacific, engine trouble, you have flight disruptions the next 48 hours or so, marginal, if at all. Market reaction there. New World is continuing to see some downside today, 2.6%. Its peer, SHK, is reporting on Thursday, and of course Shandong Gold on the back. I think Macquarie changing their forecast or their calls on both Shandong and also Zijin Mining, as Yvonne was pointing out earlier in your analyst actions there.
Yep, let's talk a little more about chips now. Key U.S. allies are getting pulled deeper into Washington's push to blunt China's tech ambitions. South Korea says it wants more incentives to encourage compliance with curbs on chip exports. Meanwhile, Japan's now been warned of severe economic retaliation from China. For more, let's bring in our China correspondent, Min Lo. There seems to be a little bit more pushback from the allies now. What are they saying?
Yeah, so South Korea is looking for more incentives in exchange for aligning with the U.S. on these curbs. And this is a new round of curbs that the U.S. is looking to impose on the AI chips, the high bandwidth memory chips. And we know that South Korea has in the past been quite successful in looking for these sort of sweet deals or exemptions, if you will, last time for Samsung and SK Hynix to continue sending equipment to their plants in China. We know that South Korea now already is unable to send certain types of semiconductor equipment to China. And understandably, the South Korean trade minister is saying that their economy is very interwoven with the Chinese one. They sell half of their chips to China. So they will need some kind of insurance, if you will, to minimize the impact on some of these South Korean companies. And also they would want to likely have some sort of multilateral framework led by the World Trade Organization, especially if there is a change of administration after the U.S. election. So they would want some form of consistency or continuation in the policy going forward.
How might Beijing look to respond or ratchet up?
Yeah, so what we're hearing is that Beijing may consider limiting the export of critical minerals to Japan, and obviously that will have huge implications on a broad swathe of high-tech applications, including the automotive industry. And that's why we're hearing that Toyota is one of those companies that has expressed its concerns to Japanese officials about the impact of yielding to U.S. pressure. And we know that Toyota has been quite involved in Japan's chip policy. It has invested in TSMC's new plant in Kumamoto, for instance. And obviously, Tokyo Electron is the target of these U.S. pressures to stop selling advanced semiconductor equipment and to stop maintaining the existing equipment that are already in China. We know that U.S. officials are now in talks with Japan to look into a strategy to ensure that they can have alternative sources of critical minerals to assuage their concern there. And they're hoping to come into some sort of agreement by the end of the year, obviously before Biden steps down in January. And legislators have also been putting a lot of pressure on U.S. government to use any sort of leverage that they have, including maybe even putting tariffs on foreign chip makers that are, competing with U.S. chip makers for market share as well.
Min, thank you. Min Lo, our China correspondent there. Now, as the chip industry faces the prospect of more tit-for-tat trade measures, one major Taiwanese firm says the solution is actually expansion. GlobalWafers is the world's third largest provider of essential materials for making chips and semiconductors. The chairperson and CEO, Doris Hsu, spoke to us about plans for funding from the Biden White House signature CHIPS and Science Act.
$400 million for our two expansions in the U.S. One in Texas, which is for 300 millimeter advanced wafer process. Another one is for our Missouri, our SOI 300 millimeter SOI operation in Missouri State. Both of these two projects together, we got $400 million US dollar CHIPS Act money, CHIPS Act support from U.S. government. On top of this, we also try to apply AMIC, Advanced Manufacturing Investment Credit from the U.S., which will be around 25%. So that's definitely very helpful for us.
Receiving that funding, though, is contingent on meeting certain milestones. And as I understand, the deals of those milestones or the sort of specifications around them are still being ironed out. So where are you at in those negotiations right now?
We just finalize PMT, the preliminary, basically the term sheet we have, both parties have agreed. We are working on the long form negotiation now. So it's not the final long form closing yet. So we're still working on the long form discussion with Chief-Back Office.
And when do you think you'd have the conclusion on that?
I would say that we don't have a schedule, but I think that it's likely that we'll get some good result by end of the year.
End of the year. You are already putting billions of dollars into your investments there.
Yes.
What are you seeing so far in terms of demand for the silicon wafers that are expected to come online?
I think silicon wafer demand definitely will grow in the next several years. Matter of fact, it's growing now, but it's just it's slowly. I'm still very positive for our operation in the U.S. For several reasons. One is that it's more and more. It's not like in the past that customers always rely on Asia fabs. They want to have local supply as well. That's the first reason for resilience reason. And the second reason is that more and more our customer, especially tier 1 customer, they care so much about ESG. So they want to make sure that their wafers carbon footprint is very environment friendly.
How much is this US expansion plan also about avoiding any possible tariff risk?
Yes, I think that's part of the reason as well. I believe that in the US, not only US but also some other countries, there will be some special tariff. And if you have the operation locally, so that means that we are a global company. We support customer locally. We can avoid from some potential tariff. That's our expectation.
And that was the GlobalWafers CEO Doris Hsu with Annabelle Jewelers there in Taichung. We're going to have more on the chip industry in the next hour. The CEO of Korean AI chip design startup Rebellions joins us to discuss their outlook on the sector and their merger with rival Sapyeong.
Right, but ahead of that, TikTok's owner Bytedance is eyeing a big US dollar loan that would be a record for Asia, excluding Japan. More on what sources are telling us about this rush to raise credits in these bond markets. Just quickly as well, while we look across a live shot of Hong Kong, update on the weather here, that there's a likelihood of a T1 today in the city between 5 to 8 p.m. today. There's a high chance to this we get a number 3 signal as far as the strong wind warning goes. And more updates, of course, this is on the back of this typhoon that barreled through the Philippines, killing 11 people. It's now headed towards China. And I think along those lines here, the markets in the Philippines are open today. FX trading resumes today after being shut yesterday, although schools and government offices in Manila are still shut. So we'll get you guys an update of all these things coming up, and hence why if you're making your way to the office here in Hong Kong this morning, it's hot, it's humid, so rush into those buildings immediately. There we go. This is Bloomberg.
Well, Bloomberg has learned that TikTok owner Bytedance is tapping banks for a nearly $10 billion loan, and it could mark the biggest dollar-denominated corporate facility in Asia outside of Japan. For more on this, let's bring in our Asia credit editor, Finbar Flynn, on more of the details of this loan and what's really in store. Finbar, what do you know at this point?
Well, as you mentioned, this is a huge loan. It would be the biggest in Asia ex-Japan if it goes through. And the expectation is that this may close later this year. So as you've seen, it's a 9.5 billion. It could go higher than that. And it is actually largely to refinance a 5 billion loan that the company took out in 2021. So they're the kind of details that we know right now.
Okay, and Finbar, I guess this is just one example of maybe early signs of a pickup in the issuance of credit. I mean, August was extremely quiet as far as Asia Pacific issuers go, but Monday seemed to show us some pickup in activity. Understandably so, I guess, when you look at where spreads are extremely tight and structurally, just the lack of supply in this market. What can you tell us about this dollar bond blitz we're seeing?
So that dollar bond blitz, we spoke to a number of DCM bankers basically before the bond blitz started this morning. We've already had 5 or 6 or 7 deals come into the market, and they will price today or for the rest of the week. So we're seeing actually deals from around the region, from India, from Japan, from China, and bankers tell us that we could see anything from 30 to 40 billion from the APAC region in this month. And that would be, if we get to 35 billion, that would be the busiest month since January of last year. So we are all bracing for the deals coming over the next week, and this won't be just in Asia, it will be in the UK, in Europe, and in the US as well, because September is a big month for fundraising.
Finbar, thank you so much. Finbar Flynn, our Asia Credit editor. Speaking of fixed income, in the next hour, PIMCO will be joining us here in shows with a preview of, effectively, they just put out a really, really good piece and report here on the falling beta of China's growth as it pertains to its role in the world and delivering growth in the world and what that means for broadly asset allocation within fixed income. Stephen Chang joins us at those times on your screens. That's in about 30 minutes or so.
Let's do a look at some of the top corporate stories that we're tracking for you this morning. Democratic U.S. presidential contender Kamala Harris says U.S. Steel should remain American-owned in her first comment on Nippon Steel's proposed takeover. She was speaking at a rally in Pittsburgh, which is home to both U.S. Steel and the United Steelworkers Union. President Biden has said he opposes the takeover, but stopped short of blocking it, pending a security review. Volkswagen shares closed higher after it said it's considering unprecedented factory closures in Germany. VW's main target is its underperforming passenger car brand, whose profit margins are getting squeezed amid a transition to EVs and a consumer slowdown. Any shutdowns in Germany would be the first in the company's 87-year history. Tesla shipments from its Shanghai factory rose for a second straight month in August, and preliminary data from China's Passenger Car Association shows the automaker shipped over 86,000 Model 3 sedans and Model Y SUVs. Now, that's up roughly 3% from a year ago and points to some momentum for the plant following a first half slowdown. Take a look when it comes to markets now. It continues to be sort of a down arrow story in China here today after we did see Chinese stocks fall the most in the month just yesterday. Right now, we're just not seeing a whole lot of catalysts out there. We're still waiting for that jobs report out of the U.S. and the like. But even the Hang Seng, we're down about 0.5% right now. We got plenty more ahead. This is Bloomberg.
Market watchers are seeing risks to the recent rally that we've seen, a massive rally, I should note, across some of these battery supplier shares in South Korea. And that's really, I guess, on the back of tepid demand we're seeing for EVs. Let's bring in our Asia Stocks reporter, Yuk-Young Lee, to talk us through the Taking Stock column of the day. And no pun intended here, what's been driving the rally across these EV battery shares?
Sure. After over the past year of steady declines in the shares prices of the EV battery maker in South Korea, in August we've seen this EV battery makers such as LG Energy Solutions, Samsung SDI, their share prices gaining more than 20% from the August lows. And this has been the first time in a while that we saw these EV battery maker shares outperforming the chip makers, which have been rallying throughout the year before those chip maker shares fell in August. So a lot of the big questions in the market was whether there is a chip rotation away from the chip stock that have been overowned to the underowned stocks like the EV battery makers in South Korea. And that's partly what has been driving the rally here. We've talked to a lot of the funds that said they have trimmed their exposure to chip stocks, the AI stocks in South Korea, such as the Samsung Electronics and SK Hynix that have gaining quite a lot this year. And instead, adding their exposure to the underowned stocks like the EV battery makers. And that has been driving the rally in the South Korean EV battery shares, even as the global EV, even as the Chinese EV battery makers such as CATL has been losing its ground.
So what does this mean? Is it a sign that the EV industry is turning around now?
So whether this is a sign that the EV industry is turning around, the answer is probably no. When I talked to the fund managers and investors, they said nothing has fundamentally changed in the industry for the electric vehicle. The battery maker has been slashing their forecast and sales target for the year. If you look at the automakers, they have been also dialing back expectations for the EV sales for the year. The demand has been pretty weak, and there's also the U.S. elections, and the outcome from the U.S. elections could also change the EV policy from the U.S. that could affect the battery supply chains in Asia. So also this rally has been more of a fundamentals, more of a valuations driven rather than driven by the fundamentals. And a lot of battery makers are also going to see the downgrades in their earnings forecast for the year 2025. So they might have to digest a lot of the negative news for the EV sector overall.
All right, Yeok-kyung, thank you so much. Yeok-kyung Lee there, our Asia stocks reporter joining us out of Seoul. Look at some top global headlines now. The U.S. is laying the groundwork for new sanctions on Venezuelan officials in response to Nicolas Maduro's disputed re-election. Bloomberg has seen documents showing the Treasury Department is close to announcing 15 individual sanctions on officials accused of undermining the July vote. Venezuela, meanwhile, has ordered the arrest of rival presidential candidate Edmundo Gonzalez for alleged crimes, including forging a public document. Bloomberg's been told that European officials expect Iran to soon ship ballistic missiles to Russia, while Tehran has provided Moscow with drones during its war against Ukraine. Sources say the potential missile transfer would mark a worrying development in the conflict. The U.S. and NATO allies have warned Tehran against such a move. Ballistic missiles can fly much faster than cruise missiles or drones with larger payloads. And Turkey has formally asked to join the BRICS group of emerging market nations. Sources say President Erdogan's administration wants to bolster its global influence and forge new ties beyond traditional Western allies while still fulfilling its obligations to NATO. We're told the move also stems from frustration over a lack of progress in Turkey's decades-old bid to join the EU.
Let's stay in geopolitics here. Well, somewhat. A senior diplomat says Indonesia will seek to sign $3.5 billion of trade and investment agreements with Africa. The vice foreign affairs minister says deals on gas, healthcare, agriculture are expected at the Indonesia-Africa Forum that's underway in Bali. Now, the targeted haul is much bigger than the roughly $600 million in deals signed in 2018 at the inaugural meeting. Now, on that note, here's your China brief and a look at what's making headlines in national newspapers, and really plenty on that last story we just told you about in Bali. Plenty of coverage on this week's forum on China-Africa and cooperation there. So the front page of the party's official mouthpiece, People's Dailies, is really all about President Xi Jinping's meetings with African leaders, including South African President Cyril Ramaphosa. He's in Beijing for a state visit, as well as attending the Africa Forum that begins actually midweek in Beijing. A Global Times editorial says the event will focus on the path to modernization and globalization. We'll be bringing you, of course, live coverage from the event tomorrow here on The China Show.
All right, another check of the markets here right now. We're watching Xstep here. They're that clothing manufacturer that's listed here in Hong Kong. So we're down close to 12% this morning. So it looks like they're giving a 10% dividend, which is a special dividend right now. But the stock is reacting negatively to that sort of news as well. We continue to watch how these Hong Kong developers are doing too, Dave, after the plunge in New World shares yesterday.
12% down, biggest drop of the year. We're down a further 2.4%. In New World right now. Henderson Land's down about 3.4. The other big one, arguably the biggest one, of course, is the second ticker on your screens that reports on Thursday. And, overall, we're still seeing declines here as well. And you got to wonder, the economic and commercial forces that effectively forced the management at New World to do what it did and recognize an impairment do apply to these other developers as well. So watch it very closely. And it's not as if the story came out of the blue. I think it was at this time last year almost that the brewing issues in the Hong Kong property space were showing up in a blowout in things like credit spreads. As you can see on the chart, the top is the Hang Seng Property Index, and as you can see, that price in itself, we've gone from north of 40,000. We're now trading at 14,000. So on price, we're back to the lowest level here since the global financial crisis. On valuation, price to book, we're trading at nearly 35% book value. So there is really, I guess, in many ways, distress being priced into a lot of these developer stocks, whether that's merited or not, of course, we'll see. But certainly the earnings and the profit warnings do underscore the challenges and the macro challenges of not just a weak commercial market, but also just higher rates. And Hong Kong simply imports that, of course, in what the Fed does.
Yeah, there's a great story on the Bloomberg here this morning. It's one of the most read of Li Ka-shing's. That building, 1881 Heritage Mall in the Tsim Sha Tsui district, where
the shopping district.
It used to be, one of those highlights when you go across the border,
across the border,
across the Kowloon side.
Yeah.
Sometimes people think it feels like you're going across the border.
I bring my passport sometimes.
No.
Yeah.
But and just how it's quite iconic, right? We used to go watch the Christmas trees there.
Yes.
People take wedding photos, and now it's only 3 out of the 30 units that are actually occupied, and most of which used to be luxury retailers are now basically gone. We'll have more of that story with Shirley Zhao coming up. But yeah, while we're talking about this, because there's not much to talk about on this board here right now, we're flat when it comes to the CSI 300. Hang Seng just slight declines lower here, but we're watching iron ore. Take a look at that Dalian price there right now. We're down close to 3% with iron ore. We got plenty more hearing from PIMCO about their latest report on key drivers of China's growth over the next few years, plus hearing from Rebellion's CEO. Welcome back to the China Show. Here's a look at the HSI a half hour into the session. Not much to see there. In fact, it's pretty slow going that we're even talking about a Typhoon 1 that's coming to Hong Kong, which usually is not much. You still got to go to school. You still got to go to work. But it's coming later on this afternoon, potentially here. But yes, what else are you watching out for, Dave?
5 to 8 p.m. is when the typhoon signal is likely going to come. Strong wind as well, signal number 3. We're down in light. I mean, it's like watching paint dry, frankly, these markets today. And, who could argue with history, right? I think in a moment we'll show you really what September looks like across most benchmarks. And not to even mention that, September and October don't tend to be the best months. And then on the back of the other side of the pond, we have U.S. elections coming through as well. So you do understand why money's moving back into cash still and sitting on the sidelines for now. Right. The dollar's making a slight bit of a comeback right now, which might also, I guess, in some ways explain why there is a lack of risk appetite today. Weakness across Asia. EMFX on your screens, led by the ringgit, which is lower by about 1/4 of 1% there against the U.S. dollar. The equity market iteration or visual of this is really a flat benchmark. U.S. futures are almost, flatter, if even that's more possible, too. We have the jobs report, of course, coming out later this week. We have inflation out of Korea, which, by the way, came in almost in line with expectations. And, of course, some data coming through out of the U.S. on Tuesday, which actually might provide your next impetus for these markets. ISM and PMI coming out, of course, later on Tuesday. Right, on September is how we're phrasing this. So it's actually the worst month for the S&P on record when you look at 30 years of data. September tends to be the worst month. It's one of the worst months for most of these other benchmarks on your screen.
I thought you were speaking French. September.
Like the cheese, camembert?
Never mind. But yes, as we say, right, it's a volatile month. Yeah. How are we approaching this here right now? Let's get the take from Mary Nicola, our MLI strategist. Mary, we talk about it's a pretty slow day. What's your team working on today? What's top of mind?
Yeah, I love the pun, by the way, on September. But I think one of the main factors that we're looking at is that we're expecting a quiet week, right? Because you've got so much heating up ahead of the jobs report. You've got U.S. ISM this week. Any sort of confirmation that the U.S. is doing okay is going to be absolutely critical. And then, of course, everyone's focused on that jobs report to tell us how much the Fed is going to cut and how quickly the Fed is going to cut as well. So it's really a matter of, we expected that there's going to be a lot of volatility this week. We're expecting to see a bit of a quiet week, and it's even more quiet because, of course, we had a U.S. holiday yesterday. So there's not much going on, but then that shifts to focus on China and the economic malaise in China. And of course, how the ability for China to really, when are they going to come out of this?
Yeah, and so far, Mary, since you brought it up, I mean, up until recently, markets at least were banking on state funds to come in and, keep some of these mainland benchmarks in check, let's put it that way. But, since the last couple of days or so, we've seen a minor leg lower. Shanghai Composite, I think, is one of the world's 5 worst markets or benchmarks on screens for our viewers right now. I mean, are we looking at potentially more downside now in terms of onshore markets?
Well, a lot of the news that's coming out has been quite weak, and a lot of the news has been quite pessimistic in terms of where we're seeing home sales headed, how the PMIs are unfolding and showing that there's disinflationary pressures that still linger in the economy. So the fact is, it just heightens the urgency for something really to come through in terms of on the policy front, but we have yet to see that. And until we see some stimulus coming through on the policy front, you're going to see a drag and more of a slump in China's equity markets.
Yep, so that continues. There's still a lot of talk about whether this U.S. equity rally can continue as well. The question of the day today is really, do you buy the S&P or do you buy the NASDAQ? What is the team thinking so far on this question today?
It's interesting because the team's quite split in terms of how equities unfold over into year end. And I think there's both a bearish case and a bullish case. I'm probably more on the bullish camp. And I think that, one of the big positives that we've seen from this earnings season is that the earnings season has really broadened out. So you're not only seeing the focus on the Magnificent Seven, but you've seen the focus also on the 493 stocks. And that broadening out of that rally is actually quite healthy in terms of, that it's not that you don't get the concentration risk that you've seen for so long. So I think in terms of what the environment is, especially for U.S. stocks, the fact that, growth is still holding up, consumption is still holding up, the Fed is on the way to ease, liquidity is ample in the markets. So it looks like, the bulls might actually win their case into year end.
Mary, thank you so much. Mary and Nicola, there are MLive strategists in Singapore for us. Right, just ahead here on shows, PIMCO will be joining us to talk us through, of course, their medium-term growth drivers that they're seeing in China. They put out this report and what they're noticing, some parallels between what happened in Japan, late 80s, 90s, into China right now. But there's some key differences, too, as far as the implications for cross-assets options and allocations. So more with Stephen Chang and his team just ahead. This is Bloomberg. Right, welcome back. You're watching the China Show. So we've been talking about the story, and a lot of people have taken notice of this. This is written by our colleague Sebastian Voigt and our MLive team. And what he's done is he's looked at where earnings have surprised the most, both sides, positive and negative. And as you can see, bottom of the barrel are effectively populated by Chinese benchmarks. And on aggregate level, that's really where you're getting the most disappointment bang for your buck. And the question he's putting is, fine, where earnings have been weak, but are analysts too optimistic?
Yes.
Is the question he's putting too.
It seems like it has been, right? Just given the amount of surprises that we have seen to the negative, right? And, just given that, what does that mean for PE ratios? Yeah. Are these valuations actually looking as cheap as they should be, or should be actually cheaper? Is the question he's really posing today as well.
Which is, I think he's saying that because they've consistently underperformed the benchmark and the consensus.
Yes.
We hear this every time as we start the year. MSCI China earnings are expected to go up 14-15%, and analysts say, well, that's a bit too optimistic. And lo and behold, earnings come in well below. So what he's saying is you have to adjust 8% to the PE ratio. So if we're trading at 10 times earnings, you add 8% on top of that. That's probably where that multiple should be. Just food for thought as we wrap up the earnings season, too. It also goes to show maybe this structural slowdown that we have to take into consideration when you look at the amount of earnings growth we'll see in China, right? So PIMCO actually, on a separate but related note here, put out this report talking about how, the share of growth that China is delivering to the global story is also on a structural downshift right now. And there are some key implications here on this report, things like, will China export more disinflation to the world? What does it mean for asset allocation? What does it mean for interest rates moving forward? What does it mean for EM? Joining us now to talk about that report, Stephen Chang, MD and Asia PM at PIMCO, joining us here on set. Good morning, nice to see you.
Good morning.
So tell us about this. What are the findings?
I think one should step back, right? We have a secular forum every year, wanting to look out the next 3 to 5 years. So we want to find some anchor points in China about what shifted, what should we be expecting the next 3 to 5 years. I think what people have been focused on China is on the growth target, whether they can deliver it. But we think it's actually less important about the actual growth target level, but is actually the components what drives the economy. Some of the old policy prescription probably won't be repeated in the next 3 to 5 years. One of the key observations that we have is that credit, for example, credit growth has been used as a way to stimulate demand and broader growth in general. We do not believe that it will be going back at the type of brisk growth that we see in credit for China. The debt level is relatively high already, and there are different risks that they want to reduce along the way. So credit growth, which used to swing quite a lot with people all tracking the credit impulse number, we have seen the credit impulse, despite some of the slowdown over the last couple of years, they have hovered around 0 to slightly negative level. So that has not been used. Now, one of the key drivers is that property has been a very weak area, and that has been a source of demand for credit. And that part, we don't expect that to pick up significantly, if at all, over the next 3 to 5 years. So the two are somewhat linked together. Right. So in order to tie in and trying to get some of the growth going, we have seen a big step up in manufacturing, fixed asset investments. Right. And that, again, that is facing some international pressure, but at least from all the policy prescriptions so far, it seems like that is still an area they want to continue. To build.
So what are the implications for investors globally and domestically? I mean, you talk about this, we were talking about deflationary trends, right? This impulse that we have. Are we likely to see China export more of this disinflation?
Yeah, I think there are two parts to it. One is more China-specific, the other more of a spillover effect. In terms of not having as much credit growth, we think that also give a more stable fixed income environment. Before, if you put a big stimulus through, credit bounce significantly, then interest rate might also need to come up along with it. We have seen China rates keep going down. Now it's getting to a level where the PBOC wanted to keep at least a positive curve and maybe some range in terms of 10-year or 30-year yield. So it's going to be more stable environment for the interest rate level. There's some scope for minor rate cuts down the line, but it's not going to be swinging massively, in our view. The spillover to other countries, I think what we have seen over the last couple of decades is when China grow, then a lot of commodity market grows, some of the manufacturing supply chain countries also grow. But if we look at the growth for the last 5 years, that correlation has started to shift. If you go back 10 years, it's actually becoming more like flat because China growth has actually been very, very steady. Right. If they deliver year on year about the growth target, there's actually no volatility. Whereas in kind of period before 2010, it's actually swing quite a lot in terms of China overall GDP level.
So I'll be careful how I phrase this. Should we invest around the assumption that there are balance sheet-like conditions in China? Is that the underlying assumption through which we should be formulating investment strategy, if in fact that's the premise of the report?
Yeah, I think the overall debt level, for example, is very much of a balance sheet issue that I think you are referring to. Yeah. And how do they manage some of the assets, for example, whether the local government might start to kind of sell some of the assets in order to plug some of the holes in local government finances. That's also a balance sheet issue that we need to watch very carefully. And then in terms of the broader kind of spillover effect, then we also think that there will be some competition now, given China is also increasing market share gain in terms of their exports. So whether some countries actually competing rather than be part of the supply chain to the whole process. And lastly is the disinflation issue that you touched on, Yvonne. With China exporting more to the global south countries, it actually dampens some of the inflation for those markets, since some of those goods would be a bigger share of the consumer basket, which to us leads to environment where local interest rate for other emerging local markets could come down, especially when Fed started to cut rates.
And I was going to say, I mean, now that you have what, Fed cuts become more embedded into market expectations, does that lead to more of this rotation into Asia FX? We've seen that, this outperformance with Asia FX and LATAM, for example. Does that continue even as China slows down?
I think so. Maybe the Chinese currency would not be rallying as much compared to other Asia FX. But to us, the dollar, particularly given the very high yield on cash, is attracting a lot of money into U.S. dollar. Now that the Fed is starting to cut rates, we expect that at least 25 basis points for September meeting, then the dollar trend might change. The way we look at the U.S. dollar is, one, whether the U.S. economic data is outperforming the rest of the world, and secondly, whether the general risk environment is a stable one. Are they worried about big risk off or big recession? We don't think the market is worried about big recession right now. And on the other hand, the U.S. data is starting to be underperforming a little bit, have some negative surprises versus the expectation, whereas the rest of the world is actually picking up. So we think in terms of currency, the dollar might come down, and then we'll be picking about which one would outperform in that context.
Is this a world that favors fixed income? If, the narrative seems to be, the Fed's hiked rates substantially. They're not going to go back to zero. But if China is, in fact, going to continue to put pressure on global prices, does that mean fixed income? And that the neutral rates further down the road are lower than we currently think they are?
Well, I think at least it's back to the pre-COVID crisis. We expect real rates, the broader regime, to be back to that kind of new normal. So maybe U.S. real rates could still be around 0.5% to 1%. Okay. And then you add on top the inflation, of course, which could be, let's say, 2% or 2.5% for next 1 or 2 years. Fixed income-wise, given current levels, it still provides a very good yield, a very good starting yield, which give you the income. And then we want to broaden out the type of opportunities we can explore, be it in the U.S., be it in Asia, or even in other parts of emerging markets where we see different cycles, different rate cutting, and currency performance.
You mentioned a little bit more about domestic credit markets in China might be steady because we don't see that credit impulse anymore. What are we seeing in terms of the bond market there? I mean, you talked a little bit more about the so-called yield curve control that China is maybe trying to undergo now. Ultimately, how do you think this is going to play out? And how is it going to affect rates markets globally?
The correlation of China rates to global rates has been very, very low, almost pretty much at zero if you kind of ignore some of the noises around it. And the cycle is different. China was cutting rates when the Fed was still hiking rates. And the inflation picture is very different than what you see globally. So we think the diversification kind of benefit for China bonds is still there. But for us, the currency may not outperform other Asian ones. Okay. And the rate itself would be a more steady range-bound one given the PBOC involvement.
Okay. A final question for you then. How real is the conversation in markets around the PBOC buying and selling at some point, potentially, in the market? Because that seems to be, from the media perspective, that seems to be what the next potential big story.
We will be watching that space very carefully. Okay. The governor had said almost the preview of that happening is more about putting the mechanism and how they would communicate once that happened. But we should expect that they do not want yields to fluctuate and swing too much around this.
All right, Stephen, great to have you. Stephen Chang there, MD and Asia Portfolio Manager at PIMCO here in our Hong Kong studios. Coming up next, Cathay Pacific cancels some flights so it can inspect its Airbus A350 fleet over issues with Rolls-Royce engines. We have details just ahead. This is Bloomberg. All right, checking Cathay shares. Not a whole lot of movement here on, of course, this story that we've been tracking all morning when it comes to Cathay Pacific inspecting its Airbus A350 fleet. And this is after they was forced to cancel some flights for precautionary inspections of that fleet after discovering issues with some Rolls-Royce engines. We did definitely see Rolls-Royce shares down in the London session as well on reaction to that. Let's get to our aviation reporter, Danny Lee, who broke this story and joins us now. What more do we know about these issues with the engine now?
Yeah, so I mean, the reaction overnight was Rolls-Royce shares being down by the most in 2 years. So it's more of a concern for Rolls-Royce than it is for the airlines. But clearly for the airlines who use this engine, which is an exclusive supplier, clearly they're a bit frustrated that any disruption they have to their operations, their fleet, they want it resolved quickly. So for Cathay doing a fleet-wide inspection, they operate two types of this A350 aircraft. They're making precautionary checks at the moment, and that will mean taking some aircraft out of service. And if, as they've said, where they found issues, they will be replacing affected parts. But interestingly, they said that it's the first time any aircraft anywhere in the world has encountered this kind of issue. So the next steps would be, is this an issue that can be resolved quickly, or is this something that could be more systemic and a longer-term issue?
Yeah, I'm looking at the list here of the flight cancellations. The Bangkok route, Singapore, Tokyo, Osaka, and Taipei. How long should we expect these disruptions to last?
At least until Wednesday, and clearly Cathay's targeting the regional routes because they want to preserve their more money-making longer-haul routes, and so that's the priority in terms of cancellations. We will hear more from Cathay later on today, and whether we see extended disruptions, and clearly, you know, when you have to replace a number of parts, do they have all the parts in stock, for example? But clearly, other airlines, operators of the A350 will be sitting up and taking notice, waiting to see what their regulators say in terms of making checks, what Rolls-Royce is saying about making checks as well, in order to see, will there be more widespread disruption in the coming days? But clearly it's a headache given what the global aviation industry has faced with supply chain issues and other issues related to aircraft manufacturing and planes not being delivered on time.
Because this is not the only engine issue that we've seen. There's been other disruptions with other companies as well. I mean, what does that tell you about the situation right now? I think Emirates' President Tim Clark had some pretty harsh words to say about this plant in particular.
No, absolutely. Tim Clark has been very vocal, particularly about the A350 and the engines made by Rolls-Royce. We've even heard from Tony Fernandez on LinkedIn. He posted the Bloomberg story, and he's driven this attack on the aircraft manufacturers, trying to make so much money, and with this duopolistic kind of state that airlines have to operate within in terms of the supply choices. So clearly, airlines have been frustrated for a while, but some are clearly more vocal than others.
Danny, thank you so much. Fantastic reporting there from Danny Lee, our aviation reporter. Here are some other stories that we're tracking at this point in time. Let's stay in the general theme of transport. Here's the VW shares closed higher after, well, the company said it was considering unprecedented factory closures in Germany. Now, VW's main target is its underperforming passenger car brand, whose profit margins are getting squeezed amid its transition to EVs and also a consumer slowdown. Any shutdowns in Germany would be the first in the company's 87-year history.
HPE says it intends to pursue a $4 billion damages claim in London against the estate of the late British tech tycoon Mike Lynch. HPE won a British civil case over the collapse of Lynch's autonomy and is awaiting a ruling on how much is owed. Lynch and his daughter were among those killed when his luxury yacht sank off Italy last month in a severe storm. All right, we're taking a look at when it comes to movers here this morning, and we're taking a look at state shipbuilding tied shares. So there has been some news there of some sort of merger plan that's in place with some of these units. So we're talking about CSSC Holdings agreeing to acquire China's shipbuilding industry. That's in a share swap deal. That's according to some of the company filings from this morning as well. So you are seeing most of these shipbuilding tied shares are jumping on that news.
Yeah, say that again. After chewing on a dry...
Shipbuilding tied shares.
Yeah, here's a dry cookie. Try it again. China Railway. Okay, this is easier to say. Thank you for my producers there for giving me this one. So, Citi is cutting its outlook on China Railway here after, of course, the company fell and the price target is now down as far as the bank is concerned. We're trading at 3 36 a pop as far as this is concerned. And we're looking at, let me just give you the price target, the new price target from Citi. And the analysts are Eric Lau. And we're looking at, well, they lowered the price target by 24%. So it's now, well, the target is now $5.30 Hong Kong cents a pop from the current levels of where we are. Okay, plenty more ahead here on The China Show.
Welcome back. We're taking a look at when it comes to chip shares here this morning, and you're seeing mostly lower, just given what we've been seeing about, a lot of geopolitics, China warning of Japan of retaliation over potential new chip curves. South Korea also saying, you got to have more carrots for us in order to kind of align with the U.S. on some of these chip curves to China as well. There you go. Taiwan semi just going unchanged at the moment, but yes, not a whole lot of movement there today.
Yeah, really reflective of just the lack of catalysts currently on the macro space. It is a quiet week until we get the jobs report later this week. Now, let's stay in chips, though, because despite what's turning out to be, to Yvonne's point, the big story yesterday was China warning Japan, this complicated geopolitical backdrop, new players are actually still jostling for a slice of the AI pie. And why not? This is a very lucrative and fast-growing space still. We're joined right now by a South Korean chip designer that recently decided to merge with its rival to boost their market clout, and we'll see how this company is now positioned for the future, and maybe we get an IPO at some point. The CEO of Rebellions joins us right now, Sunghyun Park. Sunghyun, good morning, and thanks for taking the time to join us right now. Hello, I hope you're well.
Hey, good morning. Thank you for giving me this opportunity. Sure.
Yeah, I mean, we'd love to hear more about the chip itself and this partnership you have with Samsung. I believe you've taken the design. It's now with Samsung for as a foundry to produce that. Give us an update of where you are in that process with Samsung.
Sure, you're right. As you mentioned, so we are a Korean fabless company. The term fabless comes from fabrication list. That means we do not engage in actual chip fabrication. We design the chip and deliver the design to the foundry, something like Samsung Foundry and TSMC, and they get back to us actual chips. So we design AI chip in collaborating with Samsung. We delivered our design a month later in October. We got a sample in the next year March. That as long as there are no issues in the sample, we deliver our AI chip into our strategic partner and customers, SK Telecom and Korea Telecom in South Korea data center.
So in terms of the timeline, you're saying, is it late this year or is it early next year when we might actually see these products go online?
Yeah, a little bit complicated because we are a fabless company. We design the chip, not actually manufacturing the chip. So we deliver our design into Samsung Foundry a month later. And then Samsung Foundry actually manufactured our silicon. Then they get back to us next March. Then the sample, as you can see here, is evaluate all the variation, then deliver our actual silicon chip into our customer around in June or something.
Okay, so June of next year, to clarify, is your assumption of when this might hit the market and your clients might be able to get them, just to clarify that.
Exactly.
Okay, understood. Can you give us an initial take on what demand is looking like? I know that's still about 10 or so months away. But as you point out, right, your designer, NVIDIA's one, of course, that takes their design. They give it to TSMC, though, for just as an analogy there. What is demand looking like at this point?
Oh, yes. So as all of them know, so currently AI traffic is going high right after. So Gen AI is right there. So we are focused on AI inference specifically. So typically the NVIDIA GPU, general purpose GPU, is doing very well in various type of parallel computation, such as AI training, inference, or Bitcoin mining. However, when it comes to AI inference specifically, we deliver a much higher energy efficiency and performance, especially in AI inference. So demand, as you mentioned, from the data center, Korean data center, on the the Aramco data center, Kingdom of Saudi Arabia, super high because of their geopolitical issue out there. Also, some silicon pipeline is hanged up. So I think the demand is super high because the only supplier in this scene, the NVIDIA out there.
Yeah, and we were just talking a little bit more about where you're based in South Korea. The government is asking for maybe some more incentives in order to comply with some of these export curbs that the U.S. is trying to adopt on when it comes to China. I'm just wondering, does that impact your business in any way? How are you weathering these geopolitical tensions now?
A very sensitive question. Thank you. So the first thing that I have to do, we need to comply with all the regulation. The first thing that I have to do. The second thing is to ask, so is there any way to leverage all the regulations to fully leverage incentive, and so how to meet all hardware spec defining Chinese market regulation. So first thing, the important thing to us, we need to prepare. When all the regulation is up and down, when the regulation open to us, then we first need to be prepared, meet all the specs, like under the some tops or something. So we need to redesign and re-architect our chip to deliver or serve our Chinese customers. So at this moment, as you mentioned, all the regulation is really not a very good situation, but things changed. Then our first thing we need to do is to prepare our design and our products.
Okay. Can I ask you, who are your customers then in China?
Oh, actual customer, at this moment, no. Oh, it's a good question and nice try. But yeah, talking to Chinese data center, but not very specific customer yet, because we're just, trying to fabricate a chip until the next year. So yeah, we first need to demonstrate our performance in Korean telcos and the Aramco data center, and then we directly go to the Chinese market.
Okay. I want to talk to you about your IPO. I mean, there seems to be some talk that you've hired Samsung Security as a lead arranger for this IPO. Can you talk a little bit more about that? Have you been talking to global banks as well?
Sure, yeah. So I can give you a timeline. First of all, we'd like to officially finalize our merge between the SK Sapyeon and the Rebellions. So I believe the merge is officially closed in November, 2 months later. As soon as the deal is officially closed, we plan to select global IB, global investment banks, for our international underwriters. So based on our alliance with nationwide all-out effort to compete with NVIDIA right there in 2025, we got the financial numbers and global customer in Saudi Arabia. Based on all the numbers, we plan to go public by the end of 2025 or the early of the following year. That's the entire timeline. So merge in November and select our global IB in March, then get all the number in 2025. Based on the financial number, we go public by the end of this year or early the following year.
Okay, it sounds like the plan is as clear as it can get. Do you know how much you're planning to raise?
Oh, it depends, our final valuation or something. But even now, we have enough cash at the moment. But so IPO is more than securing the money. We have the global presence in the Korean market, #1 Korean representative. So far, it's about 0.3 billion or something, but it depends, depending on the market situation or something.
Okay, now lots of moving parts, obviously, and it depends how much you'll raise and what you plan to do with that money. Well, longer term, and Yvonne and I are the idiots in this conversation as it pertains to tech. So if you could compare your technology, your design, with a company like NVIDIA's, for example, and Blackwell, for example, is that part of your ambitions to challenge a company like NVIDIA?
Long term, yes, you're right. But I'm not saying that our current technology and products are better than NVIDIA, no. But it's different products. NVIDIA's technology and product targeting, training, and inference markets simultaneously. However, our technology exclusively focused on inference market and inference applications. So in terms of functionality, NVIDIA's technology are much more flexible than us. However, in terms of inference performance and performance efficiency, I believe we are better than the NVIDIA's existing product. For example, Blackwell next year. So basically, our chip is featured in advanced chiplet technology and 144 gigabyte HBM3E, which is 5th generation of high bandwidth memory. So the memory capacity almost doubled compared to NVIDIA H100. So in terms of inference, total cost of ownership, I believe we are better than energy efficiency and the cost efficiency.
All right. Hope Jensen Huang's listening to you today. Sunghyun,
cool,
thank you so much for joining us. Sunghyun Park, their CEO at Rebellion, is joining us. Thanks for the time. Staying with chips and AI now, the launch of ChatGPT less than 2 years ago sparked an AI frenzy, the field talk of a fourth industrial revolution. And Silicon Valley names grabs, well, much of the attention, but perhaps the bigger chances are felt in Taiwan, where businesses and markets have shifted as a result. You can add Korea into there as well now. More from our tech reporter, Annabelle Jewelers.
Taiwan is the home of our treasured partners. This is, in fact, where everything NVIDIA does begins.
It's become a linchpin of the global economy. Taiwan's dominance in advanced chips has grown through the AI boom, creating fortunes in the process. Local industry billionaires are 90% richer since the introduction of ChatGPT in November 2022, while stocks in Taipei have surged. Property prices hit a record high in March, with the biggest gains in the city of Hsinchu, the home of semiconductor giant TSMC. That wealth boom is raising fears some will be left behind.
There is a worsening of income distribution across the board, and I don't see any measure to improve this at the current juncture. Parents take the brunt by helping their kids, buying apartments and so on, but it's not sustainable because the next generation won't be able to do this.
Taiwan's government, though, has set ambitious growth goals, seeking a $1 trillion economy by 2028, with GDP per capita set to surpass that of South Korea next year. Annabelle Jewelers, Bloomberg News.
Now, AI chip demand grabbing a lot of headlines, of course, yet other parts of the semiconductor industry look far less healthy. GlobalWafers is a major provider of essential materials for chip making, and the chairperson and CEO shared what's really holding back a recovery in that specific part of the industry.
There are two factors. The first one is inventory correction continue. Many of our customers' inventory is still high. And the second is that the legacy components, legacy products demand is not really as strong as the AI-related, those advanced products. I think the growth is mainly for specialized products and advanced applications.
And what sort of advanced or specialized products are you looking at in particular? Are there certain applications, for instance?
The strongest one is definitely AI-related, like GPU or HBM, special memory, or DDR5, some memory-related, and data center-related application. Those are strong. Those are very strong.
Specialty products, what's the margin improvement as opposed to a more standard silicon wafer? How much more money can you make from these?
Specialty wafers, in general, overall gross margin is very close to ordinary one. It's not really, actually price is much higher, but cost is higher as well because the volume, the scale of that specialty product is smaller than the ordinary wafer. So price much higher, but cost is also much higher. So the gross margin percentage is very close.
GlobalWafers is a company that's really grown through acquisitions.
It is.
Are you looking at any more M&A activity then to build out these capabilities?
We are, in the past 20 years, GWC was basically more than 80% of our growth was from M&A. But starting from 2022, we changed our policy because we found that it's more and more difficult to do any cross-border M&A, and it's also more and more difficult to acquire, to get advanced technology through M&A, because now more and more countries or governments consider semiconductor as one of the very important core competence or the resilience of national security level. So I think it's more and more difficult. So starting from 2022, we changed our policy from M&A focus to organic growth focus. That was why starting from 2022, we have our expansion in 6 countries at the same time, starting from 2022.
Would you say that was a lesson then from the attempted acquisition of Siltronics in Germany?
Yes, it is. That was that's the result. I think the Siltronic lesson, that the whole cycle, it took us a lot of time and resources, but the result was definitely not what we expected. So the lesson we learned is that it's not the right timing for cross-border M&A, and it's getting more and more difficult to get approval from government. So we decided to make it more organic growth.
And that was GlobalWafers CEO Doris Hsu speaking with Bloomberg's Annabelle Jewelers in Taichung. Now, if you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can join the conversation, send us instant messages, questions to our team and our guests throughout our live shows. Check it out at TV Go. This is Bloomberg.
Welcome back. A look at some top global headlines right now. The U.S. is laying the groundwork for new sanctions on Venezuelan officials in response to Nicolas Maduro's disputed election, or re-election rather. Now, Bloomberg has seen documents showing that the Treasury Department is close to announcing 15 individual sanctions on officials accused of undermining the July vote. Venezuela, meanwhile, has ordered the arrest of rival presidential candidate Edmundo Gonzalez for alleged crimes, including forging a public document. Now, Israelis took part in labor strikes and protests nationwide on Monday. It is their strongest push yet to force Prime Minister Benjamin Netanyahu's government to agree to a ceasefire with Hamas and secure the release of hostages in Gaza. Anger is rising among Israelis after the bodies of 6 hostages were found over the weekend.
Now, Russian President Vladimir Putin has arrived in Mongolia for talks with the nation's leaders and defying an arrest warrant from the International Criminal Court for alleged war crimes. For more, let's bring in Bloomberg's Terrence Edwards. He joins us from Ulaanbaatar this morning. Terrence, first of all, tell us what the mood is so far, and what are locals feeling about this visit from Putin?
Yeah, there's been a wide array of opinions, of course. Mongolia has historically had a very close relation with Russia, and most Mongolians do count Russia as the closest partner for not just for diplomacy, but to development. Mongolia has had, especially since Mongolia was closely aligned with the Soviet Union. There was a bit of dissent visible. We did see some protest yesterday. Social media was the entire spectrum. But really, if we look at polls' attitudes to Ukraine, we see that majority of Mongols would prefer a neutral stance as far as it goes to the invasion into Ukraine.
Okay, and take us through some of the other major, I guess, items in the agenda, and do you expect any progress to be made, particularly on this nat gas pipeline?
Yeah, so the gas pipeline has been an issue Mongolia's long wanted. For Mongolia, it's pretty lucrative. You look at the stability of a natural gas fuel source, and then there's the tariffs that Mongolia could collect as this fuel travels over its territory. So that's good. The downside to that is definitely, well, Mongolia is going to be only more dependent on its Russian neighbor. If we look at trade, Russia is number 2 trade partner as far as imports into Mongolia goes. 70% of that is fuels, petrol fuels. And it's also highly dependent on Russia in those freezing months of December and January, where Mongolia's own power grid is really getting to the upper limits of what it can actually produce. So that's when Mongolia is usually importing electricity from Russia as well. So there's a lot to discuss as far as partnership in the energy and trade side of things. But really what we're looking at now is ceremonies for Mongolia's long history with Mongolia, and that includes Russia's establishment of the rail system in this country.
Terrence Edwards there, just giving us a sense of these conversations coming up there in UB. Right, just ahead here on the China Show, how a slowdown in consumer spending here in the city in Hong Kong is actually leaving one of the most well-known luxury malls, this one in particular, almost empty. We look at the struggles of the city's wider retail sector just ahead. This is Bloomberg.
All right, we're checking some of these Hong Kong developer stocks after what we saw was that big plunge in New World Development yesterday. After that profit warning, we are extending those declines by another 2.5% already. So, yes, that's still sending some shivers across some developer space in Hong Kong here. The Hang Seng Property Index, though, at least is flat this morning. But many of Hong Kong's luxury malls that were built targeting Chinese tourists ready to splurge on designer handbags and watches are now sitting quiet and empty. For more, let's bring in our Bloomberg reporter Shirley Zhao, who's been focusing on one particular mall, Li Ka-shing's, over in the Tsim Sha Tsui. Tell us a bit more about what you saw.
So basically, the mall used to have, luxury tenants from Tiffany to Chopard to Cartier. But nowadays, of more than 30 units in the mall, only 3 are occupied. And they're by, an obstacle shop and, 2 watch shops.
Is this emblematic of what we could see happen to other sort of luxury retailers in the city?
We have already seen, for example, Hong Kong's top shopping districts like Tsim Sha Tsui and Causeway Bay. They used to be the world's most expensive in terms of rent, but now their sort of ranking has decreased and the prices have fallen behind, for example, the Fifth Avenue in New York. So we have seen, rents coming down by as much as 90% compared with before COVID. So Hong Kong's top luxury shopping streets have already been in decline, and analysts are saying they don't expect recovery to happen very soon, at least, not full recovery back to the sort of 2013 and 2014, which was the peak period for Hong Kong's luxury shopping.
Yeah, Yvonne needs to go on one of her epic weekend shopping rampages that might be able to salvage the sector here. Yeah. But the decline in rent, and I think on the silver lining, some of the stories in the recent weeks was it's attracted some high-profile tenants, right? So I think Prada is opening up quite a big one. I'm very excited for that.
Abercrombie and
Fitch is coming back. So there is a silver lining here.
Right, there is. And for major landlords, this is good news because major landlords, for example, like people like New World, people like CK Asset, people like Sun Hung Kai, they have a lot of flexibility. They can offer much bigger spaces for luxury brands, which are really in trend nowadays because luxury brands are racing to open bigger shops to provide unique experiences for shoppers. But for street-level shop owners, there isn't really much they can do to sort of reverse their fate.
All right, Shirley, thank you, Shirley Zhao. That great piece on the Bloomberg there, talking a little bit more about this luxury mall and really what this means for the whole retail space. Of course, you can get more on the Hong Kong edition, the newsletter as well. Got plenty more to come. This is Bloomberg.